If you are over 60, you do not have the luxury of pretending that every mistake is temporary. When I was younger, I could afford to be wrong. If I bought something foolish, time could cover the error. If a stock collapsed, I could wait. I could earn more, I could save more, I could let the machine of compounding do what it does best, which is repair the injuries of youth. That is not the game after 60. After 60, the market is no longer a scorecard, it is a roof over your head. That is the frame I want you to keep in your mind all the way through this conversation, because most people still think about retirement investing as if they are adding toys to a garage. They are not. They are building a house they will actually have to live in. And a house you live in has to do three things. It has to stand up, it has to keep out the weather, and it has to generate enough comfort that you do not spend every night wondering whether the walls are about to cave in. That is what a retirement portfolio is supposed to do. It is not supposed to thrill you. It is not supposed to impress your nephew who just discovered leverage. It is not supposed to make you feel like a genius at a cocktail party. It is supposed to preserve your purchasing power, pay your bills, and survive a storm without forcing you to sell the furniture to keep the lights on. I have watched enough booms and busts to tell you that the people who reach retirement in one piece are not usually the ones who chase the hottest thing. They are the ones who understood the job of money at each stage of life. At 35, money is a worker. At 68, money is shelter. And shelter has rules. The first rule is that safety is not the same thing as comfort. A great many people reach their 60s and 70s with a head full of half-truths. They think cash is safe because the statement balance does not move. They think long bonds are safe because the word bond sounds responsible. They think a stock with a big dividend must be safe because the check arrives on schedule. They think anything popular with retirees must have been tested and approved by time. That kind of thinking is how decent people destroy perfectly good retirements. There is no asset on earth that is perfectly safe. Cash gets eaten by inflation. Bonds get wounded by rising rates. Stocks get repriced by fear. Real estate gets hit by leverage, taxes, and liquidity problems. Every asset can hurt you if you hold it in the wrong size, for the wrong reason at the wrong stage of life. So when I use the word safe, I am not talking about magic. I am talking about fit. A safe investment for a 30-year-old software engineer is not the same thing as a safe investment for a 72-year-old widow drawing from her portfolio to pay for groceries, medication, and property taxes. One of them can recover from a bad decade. The other one may spend that decade living inside the consequences. That is why the rules change. Once you understand that, everything gets clearer. You stop asking, what has the highest return? And you start asking, what keeps the house standing? And if you force me to answer that question plainly, there are three structural supports I trust. More than the rest, when someone is over 60 and serious about staying rich, instead of merely looking rich. I call them the inflation foundation, the income beams, and the ownership roof. If those three parts are built correctly, the house holds. If one of them is missing, you may not notice the problem in sunny weather, but the first hard winter will expose it. Let us start with the foundation, because every fool wants to talk about upside before he has solved for durability. The inflation foundation is Treasury inflation protected securities, what most people call TIPS. Now that sounds boring. Good, I want boring. When you are 68, boring is not an insult. Boring is what allows you to sleep through the night while younger people are staring at their phones at 2 a.m. trying to decide whether to panic sell a position they never understood in the first place. The beauty of TIPS is not that they make you rich. They do not. The beauty is that they respect the one enemy retirees underestimate over and over again, which is inflation. A bear market is loud, inflation is quiet, a stock crash scares people because it is visible. The account statement drops, the headlines scream, the neighbors talk about it. Inflation is more subtle. It just keeps taking little bites out of your life until one day you wake up and realize the income that used to feel comfortable now feels thin. That is the way retirements get hollowed out. A retiree can survive volatility better than he can survive a permanent erosion of purchasing power. If your groceries, utilities, insurance, and medical costs keep marching upward while your income stands still, you do not need a market collapse to get hurt. Time will do the job. That is why I like owning a foundation that adjusts with the cost of living. TIPS are backed by the United States government, and more important for this conversation, the principal adjusts with inflation. When prices rise, the foundation lifts with them. That matters enormously. It means your money is not just sitting there hoping the world behaves. It is designed to account for the possibility that the world does what it usually does, which is get more expensive. In practical terms, that makes TIPS one of the few assets a retiree can own that is deliberately built to fight the quiet theft of inflation. Not guess about it, not hedge it indirectly. Fight it directly. People get distracted because they compare TIPS to stocks in a bull market. That is the wrong comparison. The right comparison is between a retiree whose core spending power is anchored and a retiree whose safe money is slowly being diluted while he smiles at a stable statement balance. If inflation runs at 3% for long enough, it cuts your purchasing power in half in roughly a generation. That is not theory, that is math. A 65-year-old can absolutely live long enough to watch that happen. Longevity is a blessing right up until your portfolio was designed for a shorter life than the one you actually get. So the first support of the house is obvious to me. I want an inflation foundation. I am not saying every dollar belongs there. I am saying that when someone is over 60, an allocation in the range of 40 to 60% of the portfolio in tips can make tremendous sense, depending on how much guaranteed income they already have from Social Security, a pension, or other sources. If you already have strong fixed income coming in from outside the portfolio, maybe you lean closer to the lower end. If the portfolio is doing most of the work, maybe you lean higher, but the principle does not change. The foundation has to hold. And here is something else retirees need to hear. The fact that something is guaranteed by the government does not make it exciting, but it makes it useful. At this stage, useful beats exciting every day of the week. The second support is the income beams. That means high-grade corporate bonds from large, financially strong companies that know how to honor obligations in good times and bad. A house does not stand on the foundation alone. It needs beams that carry weight. In a retirement portfolio, those beams are the assets that produce steady cash flow above what government bonds alone usually pay. This is where many people get themselves into trouble, because they do not distinguish between high-grade income and desperate income. A rational retiree wants predictable coupons from durable enterprises. An undisciplined retiree wants the highest yield he can find and tells himself that he is being practical. Those are very different behaviors. I have seen people over 60 destroy years of careful saving because they reached for yield at exactly the moment when they should have been reducing the chance of permanent damage. They bought junk bonds, shaky preferreds, questionable real estate trusts, complicated income products sold with a smile and a brochure, and dividend stocks from fragile businesses whose payout looked generous right before it was cut in half. That is not income investing. That is self-deception. When I talk about high-grade corporate bonds, I am talking about lending money to businesses that are strong enough to deserve your trust. Companies with clean balance sheets, deep cash flow, durable franchises, and products the world still needs when headlines get ugly. You do not need heroics here. You need quality. Think about the kind of business that can keep paying its obligations even when the economy slows down, even when financing gets tighter, even when optimism disappears. Businesses like that exist. They are not mysterious. They are usually large, established, and a little boring. Good again, when you lend to a strong company, the yield is usually a bit higher than what you get from treasuries. That difference can matter a lot when you are living from your portfolio. 1 or 2 extra points of income, earned prudently, can fund a portion of your real life without forcing you into reckless territory. But you have to respect the credit. I do not care how attractive a quoted yield looks if the business underneath it is mediocre, cyclical in a dangerous way, over-leveraged, or dependent on favorable market conditions to stay alive. It does not belong in the beam structure of a retirement house. The beam is there to bear weight. If it cracks under pressure, the whole room above it becomes unstable. So I want high-grade corporate bonds diversified across issuers and sectors, held with the understanding that interest rate fluctuations will move the market price in the short run. But quality and maturity matter more than daily quotations. If you own a bond from a strong business and plan intelligently, you do not need to lose your mind every time the market reprices duration. Still, let me be blunt. A great many retirees think all bonds are safe, simply because they are bonds. That is sloppy thinking. Long-duration bonds can hurt you badly in a rising rate world. If rates move up, long bonds lose value. Sometimes a lot of value. That pain is real, even though the word bond sounds civilized. That is why I prefer combining the inflation foundation with carefully chosen income beams, not blindly loading up on any instrument with a coupon attached to it. For many retirees, something in the range of 15 to 25% in high-grade corporate bonds is sensible, enough to add meaningful income. Not so much that you start confusing extra yield with guaranteed safety. The third support is the ownership roof. That is where dividend-paying stocks from defensive essential businesses come in. Now, if you are used to hearing people say that stocks are dangerous for retirees, you may bristle here. Let me explain the difference between stock market speculation and owning a piece of a conservatively run business that pays you cash year after year. The average stock is not safe. The right stock can be safer than people think. What makes the difference is not the ticker symbol. It is the nature of the business, the reliability of the cash flow, the strength of the balance sheet, the necessity of the product, and the culture around returning capital to shareholders. When I say dividend-paying stocks, I do not mean a random list of high-yield names scraped from a screen. I mean companies that sell things people continue buying through recessions, inflation scares, geopolitical shocks, and consumer weakness, electricity, household staples, basic health care, essential products, services that do not disappear just because sentiment turns sour. The public loves glamour. Retirement does better with necessity. If a company makes toothpaste, detergent, electricity, blood pressure medicine, or some other product that real people continue buying without much debate, that company has a type of stability that matters. The dividend matters, yes, but the business model matters more. A retiree should never ask only, how high is the yield? He should ask, why is the yield there? Can the business support it? Has management treated the dividend like a sacred obligation or like a marketing tool? Did the company increase the payout through multiple cycles or only during the easy years? I want a history, a long one. I want to see a management culture that understands what it means to pay owners consistently. I want to see defensive characteristics. I want to see pricing power. I want to see products that remain relevant even when the economy becomes unpleasant. Why do these stocks belong in the house? Because the roof does two jobs at once. It provides income now through dividends, and it gives you some inflation resilience later because good businesses can often raise prices over time. A cereal company may see higher costs, but if the brand is strong and the shelf space is secure, it can pass some of that through. A utility can often operate inside a framework that gives earning stability. A healthcare company tied to essential demand does not vanish because consumer confidence dips. That combination matters. If your whole retirement portfolio is fixed and static, inflation eventually outgrows it. If your whole retirement portfolio is aggressive and growth-oriented, volatility can break you at exactly the wrong moment. The ownership roof solves part of that tension by letting you own businesses that send you cash while still participating, at least somewhat, in the upward drift of enterprise over time. This is why I usually find that 20 to 30% in carefully selected dividend paying stocks can make sense for someone over 60. Not because I want them swinging for the fences, because I want the roof to do what a good roof does, keep the weather out while still letting the house appreciate. But I have to add a warning here because many people hear the phrase dividend stock and immediately ruin it. A high dividend is not proof of safety. Sometimes it is proof of distress. If a yield looks abnormally large, ask what the market is trying to tell you. Maybe the stock price fell because the business is deteriorating. Maybe the balance sheet is weak. Maybe the dividend is living on borrowed time. Maybe management is trying to preserve appearances while the economics rot underneath. Retirees do not need that kind of drama. I would rather own a superb business yielding 3% and raising the payout steadily than a weak business yielding 8% on its way toward a cut and a collapse. Now step back and look at the full house. The inflation foundation protects purchasing power. The income beams create dependable cash flow. The ownership roof gives you income plus a degree of long-term resilience. That is not a speculative structure. It is a livable one. And that brings me to the mistakes that collapse these houses. The first mistake is reaching for yield. This one destroys more retirements than most market crashes. When safe yields look unexciting, people get restless. They begin to believe that prudence is a kind of surrender, so they wander into junk credit, fragile real estate vehicles, exotic notes, over-leveraged products, private deals they do not understand, or stock yields that are clearly too good to be true. I understand the temptation. A retiree looks at his budget and sees that another 2% or 3% of annual income would make life easier. A little more travel, a little more generosity, a little less anxiety. So he takes a risk that does not feel like a risk because it arrives dressed as income. That is how the trap works. The danger is not only that you lose principal, the danger is that you lose principal in the section of the portfolio that was supposed to protect your life, not entertain your ambition. You can survive lower income better than you can survive a capital hole you cannot refill. I would rather earn 3% safely than chase 6% from something that can permanently injure me. The older I get, the more obvious that becomes. The second mistake is market timing. The retiree who thinks he is going to dance in and out of markets with precision is usually trying to compensate for weak structure with false cleverness. He sells because the market is falling. He buys because headlines feel better. He convinces himself he is being tactical. Usually he is just letting emotion masquerade as strategy. Even professionals fail at this game more often than they admit. The market does not ring a bell at the bottom. It does not send a polite note at the top. It humiliates the people who think they can routinely outguess it. At this stage of life, you do not need to be a hero. You need to be funded. That means making your big decisions in advance. Build the structure, rebalance it periodically, and stop behaving as if your retirement depends on whether you can read next quarter's headlines correctly. The third mistake is overconfidence. Successful people are especially vulnerable here. A person who built a business, practiced medicine at a high level, ran a law firm, or rose through a large organization often assumes that competence transfers perfectly into public market investing. Sometimes it does a little, usually it does not enough. Public markets are their own language. They require judgment about valuation, capital structure, industry dynamics, incentives, inflation, rates, and behavior. They require temperament as much as intelligence. A confident retiree who has never studied those things deeply can do more damage in a few years than a modest investor does in a lifetime. There's no shame in admitting what you do not know. The shame is in pretending you know it while risking the money that must carry you through old age. The fourth mistake is poor diversification. This one is simple and relentless. People get attached to what feels familiar. Their old employer, their home country, their favorite industry, a stock they have owned forever, a story they tell themselves about why this particular asset is different. That is not diversification. That is sentiment. A retirement house built with too much concentration has one bad storm and discovers it was never stable in the first place. The fifth mistake is ignoring taxes. A surprising number of otherwise disciplined people pay far too little attention to where assets are held and how withdrawals interact with tax rules. At retirement, your tax picture changes. Income sources shift, withdrawal sequencing matters, account location matters. A tax-inefficient portfolio is not automatically broken, but it leaks, and leaks compound. A smart retiree knows that what he keeps matters more than what he grossed on a statement. Now let me widen the lens a little because there are three background forces every retiree needs to think about, whether he likes macroeconomics or not. The first is inflation. We lived for a long time in an environment where many people started to believe low inflation was the natural order of things. It is not. It was a condition, not a promise. Aging populations, political deficits, fragmented trade, supply shocks, and the use of currencies as geopolitical tools all increase the odds that inflation behaves less politely in the years ahead than it did in the most comfortable period retirees. Remember, if that is true, then a portfolio built only for nominal stability is not safe enough. The second force is longevity. A healthy 65-year-old today has an excellent chance of living well into his 80s and a very meaningful chance of reaching his 90s. That is wonderful. It is also expensive. Your portfolio may need to function for 25 or 30 years. That means safety cannot mean stagnation. You need durability plus some growth plus inflation resistance plus dependable income. That is why a one-dimensional portfolio eventually disappoints. The problem is not merely whether you run out of money. It is whether the money you still have can still do its job. The third force is healthcare. The older we get, the more likely it is that one large bill, one diagnosis, one long recovery, or one extended care need changes the economics of the household. Healthcare inflation does not ask permission. It does not care what the market returned this year. It arrives anyway. That is why liquidity matters. That is why margin matters. That is why the house cannot be built right up to the edge of your means. Now let me bring this down from principle to protocol, because philosophy without a usable blueprint is just decoration. The first thing I would do if I were helping someone over 60 structure money responsibly is calculate the survival budget, not the dream budget, not the vacation budget, the survival budget: housing, food, utilities, insurance, medical costs, transportation, the spending that keeps life functioning with dignity. That number tells you how much dependable cash flow the portfolio truly must support. Once you have that number, the question becomes how much of it is already covered by Social Security, a pension, rental income, or other dependable sources. Whatever gap remains is the amount the portfolio must reliably produce. That gap belongs first and foremost to the safest part of the house, the foundation and the beams. After that, you calculate the lifestyle budget: travel, gifts, entertainment, hobbies, the pleasant parts of life that matter deeply, but are not the same as survival. That is where the ownership roof becomes so important, because dividend income and careful exposure to high-quality equities can help preserve the richness of life without forcing you to gamble. The second thing I would do is keep liquidity on hand. 6 to 12 months of expenses in short-term instruments or a good high-yield cash vehicle may not sound glamorous. But glamour is overrated. Liquidity is the thing that stops a temporary problem from becoming a permanent wound. If the market is down, if a medical event appears, if the roof leaks literally or financially, liquid reserves give you time to make decisions without desperation. Desperation is expensive. The third thing I would do is set a withdrawal discipline for a long time. People loved quoting the 4% rule as if it were a law of nature. It is not. It was a rule of thumb born in a different yield environment. In a world where conditions are different, prudence might mean beginning closer to 3% or 3.5%, then adjusting based on reality rather than dogma. The point is not to worship a number. The point is to avoid pretending that a portfolio can give you more than it safely can just because a rule from another era sounded tidy. The fourth thing I would do is rebalance, not every day, not emotionally, not because television told me the world changed by lunchtime, periodically. If stocks run too far ahead and swell beyond their role, trim them. If defensive assets outperform and the balance shifts too far, reset it. Rebalancing is one of the few civilized ways investors force themselves to buy lower and sell higher. It is not exciting, but it is sound. The fifth thing I would do is be honest about whether I need outside help. Not all advisors deserve trust. Some sell products, some sell stories, some sell reassurance at institutional prices, but a fee-only fiduciary who understands retirement cash flow, taxes, withdrawal strategy, and risk can be useful, especially when complexity rises. There is no prize for doing everything alone if alone leads you into preventable mistakes. Now I want to say something slightly uncomfortable. Many people over 60 still invest as if they are trying to prove something. They want to prove they still have it. They want to prove they are not old money people who move too conservative too early. They want one more great score, one more brilliant pick, one more stretch of outperformance that lets them feel younger, sharper. Faster than caution suggests, I understand the emotion, but retirement money is not ego money. It should never be used to audition your intelligence. The market does not reward pride. It punishes it. Your money after 60 has one sacred job, and that is to protect your life from becoming smaller, meaner, and more fragile than it needs to be. That is the mission. The mission is not to beat strangers. The mission is not to win every year. The mission is not to maximize the number on a statement. The mission is to keep your house livable. When that becomes your frame, a remarkable thing happens. You stop feeling deprived by discipline. You start feeling protected by it. You realize that boring assets are not boring when they are the reason you can pay your bills. Remain independent. Help your family sleep through market sell-offs, and refuse the humiliations that come from financial desperation in old age. You realize that a 3% yield earned honestly can be better than a 7% yield loaded with hidden fragility. You realize that preservation is not passivity. It is wisdom with a longer time horizon. You realize that dividend checks from a strong business are very different from reckless bets dressed up as income. You realize that inflation is a more disciplined enemy than volatility because it never gets tired. You realize that what looked conservative at 40 may actually be intelligent at 68. And finally, you realize that the best retirement portfolio is not the one that creates the most envy. It is the one that creates the most peace. That is why, if you press me to name the 3 investments I trust most for people over 60, I come back to the same 3 supports. Tips for the foundation, high-grade corporate bonds for the beams, dividend-paying stocks from defensive, necessary businesses for the roof. Could you add a little here and a little there around the edges, of course. Every household is somewhat different. Taxes differ, spending differs, temperament differs, existing income differs, but the logic does not change. Protect purchasing power, create predictable income, own some productive businesses that can keep paying you through multiple seasons. That is the house. Now, the final choice is simpler than people want to admit. You can build a retirement around excitement, opinion, yield, chasing, and ego, and then hope the weather stays nice. Or you can build a structure designed for rain, inflation, illness, volatility, and a longer life than you originally expected. One path flatters you, the other one shelters you at this age. I know which one I would choose. More important, I know which one I would want for the people I love. Because when the noise fades, when the fads pass, when the hot sectors cool, when the pundits move on to the next emergency, what matters is very simple. Can your money carry your life without breaking it? That is the test. And if you are over 60, it is the only test that really matters.